Nike stock keeps falling, and as I'm recording this, the stock is trading around $43 per share. Less than a year ago, it was close to $80. So we are talking about a massive collapse in one of the most recognized and iconic brands on the planet. But here is the interesting part. For some investors, this may finally be one of the most attractive moments Nike has seen in years. Not because everything is perfect, not because the company has no problems, but because the market may now be pricing Nike as if the brand is permanently broken. And that is where things get interesting, because Nike is not some tiny company burning cash and fighting for survival. This is still Nike. The company closed fiscal 2026, which ended on May 31st, with $46.4 billion in revenue. $46.4 billion. So let's be clear, the company did not disappear. It did not lose its global scale. It did not lose the swoosh. What Nike lost was momentum, and that difference matters a lot. Because when a company is truly broken, sales collapse, inventory explodes, cash disappears, and insiders usually run away. But with Nike, something more complicated is happening. Full-year revenue was basically flat on a reported basis. Nike brand, excluding Converse, generated $45.2 billion in revenue. Wholesale revenue grew 6% for the year. North America, Nike's most important market, grew 5%. And Nike footwear in North America also grew 5%. That is a huge detail, because right now, a lot of people are talking about Nike as if nobody is buying its sneakers anymore. But that is not exactly true. Globally, Nike brand footwear still generated $29.5 billion in annual revenue. In North America, footwear revenue reached $13.3 billion and grew 5% from the prior year. So yes, people are still buying Nike sneakers. That is not the problem. The problem is that the business is uneven. And honestly, that is probably the best way to describe Nike right now. Uneven. North America is holding up. Footwear is still selling. Wholesale is improving, but China is weak, digital is weak, Converse is weak, Nike Direct is weak, and parts of the lifestyle and sportswear business are still under pressure. In Greater China, Nike footwear revenue fell 13% for the year, and 15% on a currency-neutral basis. Nike Direct revenue fell 6%. Nike brand digital fell 12%. Converse revenue collapsed 31%. So yes, there are real problems here. This is not one of those situations where the market is completely wrong and everything is secretly perfect. Nike has problems, but this is also not the complete destruction of the business. This is a giant company going through a painful transition, and that is where the opportunity may be, because the market is pricing Nike like a brand in permanent decline. But the numbers still show a company with $46 billion in annual sales, $9 billion in cash and short-term investments, controlled inventory, a global distribution machine, and one of the strongest sports brands ever built. And inventory is especially important here. Nike ended the year with $7.5 billion in inventory, basically flat compared with the prior year. That matters because one of the most dangerous signals in retail is when inventory gets out of control. When that happens, the company is forced to discount aggressively, margins get crushed, and the brand itself can get damaged. But Nike's inventory did not explode. It was flat. And that changes the story. Because if sales were collapsing and inventory was exploding, this would look very different. That would look like a brand losing control. But that is not what the numbers show. The numbers show a company under pressure, but not a company falling apart. And while the market is punishing the stock, insiders have been buying. Tim Cook, the CEO of Apple and a member of Nike's board, bought 25,000 shares at an average price of $42.43. That is more than $1 million. John Rogers Jr., another Nike board member, bought 4,000 shares at $43.34. And Elliott Hill, Nike CEO, bought more than 23,600 shares at $42.27. That was roughly $1 million in stock. And this is important, because this is not the same as receiving stock as part of a compensation package. These transactions were filed with transaction code P, which means an open market or private purchase. In simple terms, insiders were buying shares near the lows with real money. Now, of course, insider buying does not guarantee anything. Insiders can be wrong. CEOs can be wrong. Board members can be wrong. But it does tell you something. It tells you that the people closest to the company are willing to put money to work at these prices. And that is not nothing. So the question is simple. Why are insiders buying Nike right when the market hates it? The most likely answer is that they believe the market is overreacting. And they may be right. As I'm recording this, Nike has a market cap of roughly $64 billion. Against $46.4 billion in annual revenue, the stock is trading at roughly 1.4 times sales. For a global, profitable, dominant brand with cash, dividends, distribution power, and decades of pricing power, that is not a hype valuation. That is a punishment valuation. Now, to be fair, Nike is not insanely cheap on every metric. The stock is trading at roughly 20 times fiscal 2026 diluted earnings per share of $2.10. And even that number needs context, because Nike's fourth quarter earnings included a large one-time tariff recovery benefit. So no, this is not some obvious no-risk, deep-value stock. That is not the point. The point is that Nike is no longer being valued like an untouchable premium growth brand. It is being valued like a company that has lost investor confidence. And sometimes that is exactly where turnarounds begin. There is also another interesting data point. Even though Nike's cultural momentum is clearly not at peak levels, its digital footprint is not dead. Alt-Index estimates that Nike's website still receives around 105 million monthly visits, up more than 10% over the past 3 months. That is not explosive growth, but it is also not a dead brand, and this is the real bullish thesis. Nike does not need to be perfect for the stock to recover. It only needs to stop getting worse. That is the key. If Nike stabilizes China, improves digital, fixes Converse, pushes more performance products, rebuilds momentum in running, basketball, soccer, and training, and keeps growing in North America, the market could start treating it like a premium brand again instead of a broken one. And management seems to understand the problem. Nike is moving back towards sport, performance, product innovation, and wholesale relationships. The company is also preparing more than a dozen new footwear styles in the second half of fiscal 2027. And that matters because Nike's issue was never that people forgot the brand. The issue was execution. The product cycle got stale. Digital slowed down. Competitors like Adidas, Hoka, On, Anta, and Li Ning gained attention. China became difficult, and Nike lost part of the cultural energy that once made it feel untouchable. But execution problems can be fixed. Brand death is much harder to fix, and Nike does not look dead. It looks wounded. That is a very different setup. Buying Nike around $42 or $43 is not buying the company at its best moment. It is buying an iconic brand during an ugly moment, while the stock is near its lows and insiders are stepping in. And honestly, that is usually how these opportunities look in real time. They do not look clean. They do not look obvious. They do not come with perfect numbers and perfect sentiment. If everything already looked great, the stock probably would not be trading near multi-year lows. Sometimes the best opportunities appear when the numbers are mixed, sentiment is destroyed, and the market has already priced in a lot of pain. Nike was doing $46 billion in sales before this crisis of confidence. It is still doing $46 billion in sales. The brand is still here. The sneakers are still selling. North America is still growing. Inventory is under control. The balance sheet is strong. And now the CEO and board members are buying near the lows. So no, Nike is not risk-free. China could remain weak. Digital could keep struggling. Competitors could keep taking market share. And the turnaround could take longer than investors expect. But at these prices, Nike starts to look less like a permanently broken company and more like a punished giant that may be preparing for a comeback. So the real question is this. Are we watching the decline of an iconic brand, or are we watching one of the most hated blue-chip turnaround opportunities in the market? Because if Nike gets this right, $43 may look very different a few years from now.